Like bonds, the value of a stock is essentially the present value of all future cash flows that the stockholder expects to receive from owning the stock. However, unlike bonds, the future cash flows in the form of dividends from a common stock are not fixed. As a result, the value of a common stock is derived from discounting the expected dividends. 3 stock valuation techniques will be discussed here: discounted dividend model, constant dividend growth rate model, and price-earning ratio valuation model. Basically, here are the steps to estimate the value of a stock. First, estimate the amount and timing of future cash flows. Second, evaluate the riskiness of the future dividends, and determine the rate of return an investor might expect to receive from a comparable risk investment. This is essentially the required rate of return. Third and final, calculate the present value of the expected dividends by discounting them back to the present at the investor's required rate of return. Let's go through an example. You intend to buy a stock at $50 per share, and hold it for 1 year. What will be the value of the stock today if it pays a dividend of $2 per share, and the investor's required rate of return is 10%? From the calculation, the present value of the stock is $42.27. What if you hold it for 2 years, and sell it for $60? Let's recalculate the outcome. If you hold it for 2 years, the present value becomes $53.06. As you can see from the previous examples, valuing stocks using the discounted dividend model is difficult as you have to forecast the future dividends, which is highly challenging. Valuation would be easier if we assume the dividends grow at a fixed or constant rate. This brings us to the next technique, the constant dividend growth rate model. With this model, a firm's dividend is expected to grow by a constant rate each year. The value of a stock would look like this. D0 is the dividend paid in year 0. G is the fixed annual growth rate of the dividend. R is the investor's expected rate of return. The previous formula can be simplified to the following. D0 is the dividend paid in year 0. D1 is the dividend paid in year 1. G is the fixed annual growth rate of the dividend. R is the investor's expected rate of return. Let's go through an example with the previous formula. A common stock paid $3 dividend at the end of last year, and is expected to pay a cash dividend every year from now to infinity. Assume that the dividend will grow at a rate of 2% annually. What is the value of the stock if the investor's required rate of return is 10%? First, we need to calculate the next period dividend, D1. D1 is equals the previous period dividend, $3 times 1 plus the dividend growth percentage. You will get $3.06 for D1. Next, apply the constant dividend growth model you learned in the previous slide. you will get $38.25 as the value of the stock. Let's revisit the constant dividend growth rate formula and see what actually affects the value of the stock. From the formula, we can identify three factors affecting the value of the stock. First, the most recent dividend, D0. Second, investors' required rate of return, R. And third, the expected growth rate of future dividend, G. A company's performance metrics such as earnings per share, book value per share, sales per share, and cash flow per share can be used to value the company. In such case, the multiple is determined by the multiples observed from comparable companies. The most common metric is earnings per share, better known as EPS. Price-earnings ratio, or better known as P/E ratio, is a popular technique for stock valuation. P/E ratio identifies how many dollars investors are willing to pay for each dollar of the company's earnings. The price-earnings ratio approach to stock valuation is simple. It is calculated by multiplying the estimated EPS with the appropriate price-earnings ratio from comparable companies. Let's go through an example. Let's assume that price-earnings ratio from comparable firms are listed in the table on the left-hand side. The average of the price-earnings ratios are calculated, and it is 21.88. As a result, a company with an earnings per share of $2 would have a stock value of 21.88 times $2, which is $43.76. We have been looking at the valuation for common stocks in the previous slides. Preferred stock, however, should not be valued the same way. This is due to the fact that a holder of a preferred stock usually receives a fixed dividend. As a stock is non-maturing, it is in perpetuity. Therefore, the formula for preferred stock valuation would look like this. Let's walk through a simple example. What is the present value of a preferred stock that pays a dividend of $5 per share? Note that the market's yield on similar issues of preferred stock is 7%. All you have to do is to plug in the numbers in the formula stated in the previous slide. The answer is $5 divided by 7%, which is $71.43. In other words, the present value of the preferred stock is $71.43. Thank you for watching.